All right. Good afternoon, everyone, and welcome. My name is Steve Torso. Appreciate everyone joining. Obviously, we sort of announced this morning, just given that we are going to be hosting the Business Exit Summit next week. And to be blunt, I was blown away by the sort of interest over the first two sessions. And I thought we had so many different people replying back saying, basically about hosting another one. So we decided to host a third and final session. So welcome to everyone. And if you're joining us sort of afterwards and you're watching the sort of recording, obviously I'm doing this sort of live tonight on Monday. What date is it? September 1st, the first day of spring in Australia. Uh, so I'll give you a bit of a background for this session. And by the way, just while I'm giving the background, I'd love to know where everyone's joining from. I was always curious. Last time, I think we had about 8 or 9 different countries sort of joining us for the session. So, whether it's sort of morning, noon, or nighttime where you are, always love to hear where everyone's joining from. So just put into the chat where you're coming in from. But as I've been saying to everyone, this has been in my mind for a long time, and I've obviously been doing a lot of sessions around capital raising education for pretty much the last sort of 5 to 6 years. And as I started to think about the strategy and I started to think about my own business, I started to really understand the value about being able to articulate the strategic value of your business and the important role that plays, because often we really get bogged down in articulating, sort of what we are doing from a day to day and what's unique about what we do and so forth. And really, we don't sort of know how to articulate what we do often from an investor's perspective or even a strategic buyer's perspective. By the way, I just see everyone's joining from Sydney, Singapore, which is fantastic, where we just hosted an event last week. So I thought it was a really good time to do this. And also there was a couple factors that really happened for me. And the ones that happened was that, number one, someone that was becoming a shareholder in my business, Jim Lowry, really highlighted to me about the upcoming transition that's taking place and how it's the biggest wealth transition in history, which is the baby boomers transitioning their businesses to the next generation, or for some, looking to sell their business. And unfortunately, many of those will actually close down. I've actually got a family member going through that right now, where effectively the owners are just deciding to retire and they're just shutting it down. And funny enough, structurally, that's actually one of the biggest threats that I know that's facing the UK. I know it's facing the UK, is that the potential loss of tax base of companies that have been going for 10, 20, 30 years, and the owners just being baby boomers just deciding to retire. And therefore the business just discontinues from that point. And by the way, I can still see people joining, so welcome. I see someone's joining from Adelaide, which is great. So in hosting this session, it was really Jim that sort of sparked me sort of thinking about this as an area. And then obviously when we started, putting together the Business Exit Summit, I knew that this was a topic which is really sort of not talked about too much in the ecosystem. It's been talked about a lot in books. There's been a lot of investment bankers do this as part of their day-to-day. Corporate finance specialists or M&A specialists, this is what they live in, bread and butter. But often founders don't know about it. So for me, I'm very good at I'm very good at taking things which are pretty complex and pretty intricate, and then finding an easy way to explain it. Because to be blunt, I have to find a way for my simple brain to understand something. And then also, in thinking about my own business and my own journey, I wanted to sort of articulate to people, how we've been able to do what we've done, but also the way I think about my own business as well, because it relates to how you operate, your own business, but also for some of you, it may be your portfolio company. So that's the sort of genesis behind tonight. And at the end, I will talk about the Business Exit Summit, because obviously it's coming up very quickly. It's coming out, basically starts next Tuesday. So we're 8 days away from it. I've got a crazy special offer for everyone that's interested in coming along to it. And look, to be blunt, I've never put together a speaker list like this. I'm never going to put together another speaker list like it again. It's been an incredible amount of work on our side in pulling it together. And the reality is, for anyone that's looking to meet investors, that are looking to fund these types of deals, or to meet other founders that have been through this journey, or to meet, effectively the advisors that make these kinds of deals happen, there's pretty much no other place in Australia that you can get that all in one hit. So I'll go through that sort of special offer at the end. But effectively, the first starting point is to understand that in our businesses, there's effectively three states of value, right? There's operational excellence, and this is, I'm talking about selling your business at a premium. There's operational excellence, which is really focused around the financial and the operations part of your business, and is fantastic if someone is thinking about just a pure financial exit. Then we've got the strategic potential, and this is probably what I'll spend most time on in this session. Not probably, it is what I'll spend most time on in this session, because that's where the real value unlock happens. And then the last one is the maximum value, which is when you've got the combination of operational excellence and also the strategic potential there. So the fortress, and I've broken this down into the fortress, the key, and then also the citadel. So the fortress is basically what people would expect in a financial sale. And this is what most people think about. It's about the business being perfect, and effectively you're selling that profitability, the predictability, and efficient operations, right? And this is what sort of really sets the foundations for what's going to become a strong financial sale. The part I'm going to be really talking about is the key, which is the unlocking of value through strategic potential. So this typically occurs when people either have in their business some sort of unique IP or product that's really hard to replicate, unique data that you have access to, market access that you've been able to dominate and that someone else wants to access, disruptive potential with your IP, and this obviously goes back to the IP aspect, your brand positioning in your market, and then also your distribution and ecosystem, right? So, because sometimes they're things which, someone, when they're looking at a business, can unlock a massive amount of value for their existing business, but for you, it's what you're striving away for day in and day out. So the citadel is the ultimate state that we'd all love to get to. And it's funny, when I talked about this, people were saying, oh, I wasn't really thinking about an exit or so forth. It's actually, regardless, whether you're thinking about an exit right now, this is more about engineering the value of your business over time. And it's being able to understand how to articulate that to either potential investors or potential buyers, right? So when someone's trying to understand why you think your business is worth something, this is you being able to articulate it and having the information to back it up, right? So this is the ultimate strategic asset that we want to build for a potential investor. And just to be clear, everyone I've interviewed in this process have highlighted that strategic exits often happen 2 to 5 years. The planning and the engineering and the structuring happens 2 to 5 years in advance. I very rarely have met an advisor or specialist in this space that says, oh, it only takes 6 months, or people were prepared when they came to us. So the blueprint, to give you a bit of an idea, we're going to talk about the first part, which is the 7 pillars of operational excellence. Then we're going to be talking about how to master that art of your strategic narrative. And this is the key playbook. So the first part in building your fortress, the first part is understanding the financial fortitude of the business, so the financial strength of the business. Then the growth potential. These are all things that if someone's looking to buy your business as a financial buy, they want to understand what the growth potential looks like and what impact that could have on the current business. Then they want to understand the independence narrative, right, or imperative. So how independent is the business from you? What happens if you leave the business tomorrow? Then it's the customer diversification question. I'll give you some simple frameworks to think about your business. And by the way, this is a 1-hour information session. So the part I'm covering is very high level and is enough to get someone started on their own thinking about their own business. Systems and scalability, the competitive moat. And as I'll sort of mention, being able to say you got great customer service, it's not enough, right? It's really understand, what does a buyer think about, or what does an investor think about when they're trying to understand what your true competitive moat is. And then the last one is the exit ready team, right? And I'll take you through some sort of guidelines and simple things to think about in that sort of exit ready team aspect. So to understand, and by the way, part of this is talking about from a buyer's perspective. So to understand when they're looking at your business, effectively, of course, you want to sell the opportunity. What they want to understand, and they'll typically have some sort of analyst inside their company or advising them, they're on their deals team, where what they're doing is they've got their own buyer's risk checklist, right? So this is the scorecard that they run through, right, where they're understanding what sort of premium can they allocate to your business. So in understanding the customer and the revenue risk aspect, the first thing they're trying to understand is your customer concentration. Do you have any of your customers which represent more than 15% of your revenue? The reason why that's so important is because if one customer of yours represents 50% of your revenue and you lose that customer, they've effectively lost 50% of what they've just bought. There's a great example I had with a sales mentor session, as part of a group that I'm involved in, where basically the company had one customer and it was Telstra. And effectively it was highlighting the risk for them of having it, but yet they were making so much money that they didn't really put that emphasis too much on getting additional customers. Well, Telstra ultimately pulled that contract and that business went out of business. So customer concentration is a massive one. Then there's the retention and contracts, right? So are there any relationships, contractually or dependent on you personally? Because this is an important risk scorecard for them, because if you leave the business, what amount of contracts are actually going to be going with it, right? And then also how exposed is the revenue to a single market segment or a geography? And I'll give you an example of that. There was a business that I was dealing with. It was an online marketplace, and effectively it was in COVID times, and they explained to me how their revenue was absolutely decimated. Well, it made sense when I found out what their business did. Their business was decimated because their whole business was around helping people online plan their weddings in exotic locations. Right, where I'm talking about for wealthy people where they want to take out the entire hotel, plan their wedding, have all their friends and family staying there. They got absolutely smashed, and of course they couldn't run it online, right? So they were dependent on effectively, that in-person market for themselves. We also had that same issue, during COVID, where we were dependent on events, and we figured out how to actually take everything online. Then when understanding the operational risk part, it's, that old saying of, can you leave the business for 3 months and come back to something more than a car park? They really want to understand that. And then this is probably something you may not have thought about, but if they're going to acquire your business and then inject some capital in it for growth, can your current systems handle more than 50% growth, more sales without breaking? Right? So, because if that's the case, right, it's showing them what potential cost is going to cost, what the potential cost is going to be if there's going to be additional growth beyond that. Working capital efficiency, and then competitive moat. The simple framework to ask yourself is, what truly stops a well-funded competitor from copying you? If you can answer that question, then you really understand what your moat is. Right? What is to stop them from coming into your market, throwing a ton of money at it, potentially acquiring your current staff, offering them 10, 20, 30% more than what you're currently paying them, and then effectively, taking your business away from you? What is that truly competitive mode that has your customers sticking with you? Right? IP and asset protection, obviously that's highly relevant, especially to the technical businesses, right? How is that actually structured and how is that set up? And then this important one here of team retention. What incentives keep your top talent staying with you for 3 years post-acquisition, right? So how are they incentivized to stay with the business, especially some key team members? What they'll typically want to know is they'll want to know who are the core team members within your business that effectively make the business work. Right? Obviously, they rely on you. You're across multiple things as a founder, but who are the other people that effectively the linchpins that sit inside your company? Right? So that's on the operational side. Now, on forging your key, it's really understand that the fortress, having a sort of operational excellence, gets you a great price, but the key is what's really going to get you the strategic premium that we all want for our own businesses. right? So understanding that is that as a financial buyer, what they're effectively buying, the question they're asking themselves is, what is the profit stream I am buying? Their goal is to have the business as a standalone operational asset that has predictable cash flows, right? That is the outcome they want from the transaction. So from your mind, what you're selling to them is a proven, predictable, de-risk profit stream that they can acquire and expect to operate and get cash from, right? That is a typical financial buyer, and that's what they're looking to buy, right? And of course, there's all the other parts about if they invest X amount of capital, what are they likely to get return from it, etc. But that is how a financial buyer sees your business at a really fundamental level. On the other side, the strategic buyer, what they're buying is they're looking to buy a key that unlocks additional value for them. And the question that they're asking themselves is what can we create with this asset, right? Or with this business, right? Or the assets that sit inside the business. Their goal is to incorporate your business into theirs and to unlock new revenue streams, new synergy, and effectively the ultimate saying that people always have is how can we take 1 + 1 and make it equal 3, right? But effectively what you're selling to them is that you are a unique asset that is very hard to replicate, that unlocks future potential inside of their business. When you understand it in that framework, you start to see your business in a completely different way, right? And I said it's really important that I know we're in our business operationally every day. This helps us stand outside of it and understand it from the perspective of someone who's looking to either invest, looking to buy, etc., or if they're just thinking about it just as a pure financial sale. And by the way, absolutely no shame in a financial sale. I said it's incredible for you to have built it to that level where someone wants to do that. The thing that we're trying to articulate is there is other levels of value if you understand what they are and how to articulate it. So to understand what your key is and what your strategic value is, there's effectively 3 strategic lenses that you need to look at. One is the unfair advantage lens. So what do you possess that your competitors cannot easily replicate, even if they had significant access to capital? So I'll give you my example, right? So with Wholesale Investor, we've literally seen hundreds of platforms come and go over the years. And effectively, one of the hard thing that's hard to replicate on our side is that we've actually built an ecosystem that's 3-sided: investors, companies, and also the industry participants. And we've been able to build that along with an in-person experience as well. Right. So for us, if you think about how much money would someone have to throw at to how many millions would they have to invest to replicate what we've built, and how long would it take them to do that? Right. So in your case, it could be proprietary IP, it could be a data moat that you have that's really, that's irreplaceable. It could be a brand presence that someone's looking to get afterwards. Like, for example, like the Culture Kings one is a great example of that. Or it could be regulatory approval, right? If you're in the technical areas. The next one is the acceleration lens. So effectively, what do you have that sits inside your business? What assets do you own? What IP do you own that effectively would save a large company 2 to 3 years of R&D, right? At a base level, right? Market entry, customer acquisition, etc. Like, what customers do you have that someone would want to access? What market segment do you own? What geographical region do you own that someone would want to accelerate their business into, etc.? So in this, it's highlighting niche market access, established distribution channels, and also it could be a highly specialized engineering team. For example, you're seeing that fight take place right now on the AI wars, right? And then the ecosystem lens. How does your business make other products in a large ecosystem, right? So, how does our business make other products in a larger ecosystem more valuable? So that creation of that, remember I mentioned about the 1 + 1 = 3, that's what you're going for. So the most beautiful, simple example of that is Facebook acquired Instagram when it had no revenue, 12 people, but was accelerating quickly because they could plug that asset into their monetization angle, into their monetization, business. So they were going to be able to monetize the traffic that Instagram was getting far faster than what Instagram could by themselves, right? Now, likewise, you saw this, and what people don't know is that one of the first acquisitions from Google was AdWords, right? So AdWords helped Google monetize, right? So they had the search engine, they had the algorithm, down packed, but then they had to monetize it, and they made an acquisition to unlock that value that was sitting inside what they were getting from a traffic perspective. So the real key is then being able to articulate your key, for any capital event. So whether it's a capital raising or it's a strategic exit, effectively you need to articulate in such a way that it makes sense and aligns with the thesis of the person you're having the conversation with. So whether it be the investor or whether it be the acquirer, effectively you have to articulate your key in a way that makes sense to them. And the actual real skill is to have them articulate it to you, right? So in a simple example, right, here's the formula that you want to get to, right? And this is what you need to have in your own thinking. As I said, it's best to start with the end in mind and effectively help others come to that conclusion, right? So for XYZ company, right, your potential acquirer, our unique key, right? So our IP, our data moat, our distribution, our brand, our product, etc., unlocks their specific value, right? Their high value opportunity, which they cannot achieve without us because of XYZ, our defensible data moat. So for example, our distribution, right, across companies, investors, and also industry could help the right acquirer achieve multiple revenue streams or unlock a whole bunch of value that sits inside of our ecosystem because we've spent 16 years building our distribution and we've got a brand relationship with our audience, right? So this sentence works both well for a premium capital raise today and a high value exit tomorrow. And for my own personal example, for many, many years, investors just thought of us as an events company. They didn't understand the platform component. They didn't understand the three-sided marketplace and how hard that was to achieve. They didn't understand the ecosystem. And do you know why? Because I didn't articulate it. I didn't know how to articulate it, right? It was actually a shareholder that really helped me articulate and refine that messaging for myself, right? I knew it inside of myself, but I just wasn't communicating in the right way. So 2 Australian examples of this. So for a premium capital raise, one of the examples is, Woolworths, which is everyone knows is our favorite grocery company, right? I say that jokingly. Basically did a strategic investment into a company called Quantium, which was at that time Australia's largest big data company, right? Now you'd think it'd be someone like Google making this type of investment. But the reason why Woolworths did it is they wanted hyper-personalized customer insights, and then also they wanted to build their next generation loyalty program. So if you're a part of the Woolworths sort of loyalty program, you'll understand why you get hyper-personalized offers for you. It's because they've invested into a company back in, I think it was 2012, 2013, that helped them hyper-personalize this based on your data. They were able to get the de-identified data from Quantium, which had a combination of the Woolworths reward program and also a bunch of credit card data that really assisted them in doing that. So with their advanced data science capacity, they were able to create a whole new revenue opportunity for Woolworths to help them create those hyper-personalized offers. Now, that value is worth over $1 billion, right? The other example is Aconex. So in Aconex's scenario, Aconex owned they had cloud platform offerings in the construction area. So Oracle, when they acquired Aconex, the reason they did was it gave them instant domination over the construction vertical, right? When it comes from offering software solutions to that vertical. So they could offer all sorts of products to that, but it gave them market dominance. That's why they paid $1.6 billion for it. So it's really important to understand that, say, when they can put down more products to those to that sort of to their existing customers, it means that not only can they buy it, they can dominate it, they can expand in it, but then they can also offer some of their other products, to that market. Now, why strategic? Now, there's another situation that typically happens is strategics. I just spilled water on myself. Will often invest first, right? And there's a reason why they do that. And this is effectively their insider's playbook. So the reason why they do that is, number one, strategic alignment. So typically you'll find that they'll have some sort of thesis internally, right? From a corporate, they call it corporate development perspective. And then they want to, they basically want to explore that thesis. And typically the way they can do that is by investment. So if what you're doing solves a challenge that they have or is aligned with their market thesis or part of their market entry or whatever it may be, then effectively you can unlock something, some sort of potential opportunity which is already on their roadmap, right? That they're thinking about for the next 5 to 10 years. You are solving a future problem for them that they already have in mind, or you're unlocking a new market for them. So strategic alignment is one why they do it. The second one is try before you buy. So often these deals are done where they're taking a 20% stake or a 30% stake in a company, and it becomes their ultimate due diligence because they get information rights, they often get a board seat, they get to get a feel for how you operate, how you run your business, how the business is actually performing, etc. And that gives them a great insider's lane to if they want to really acquire the business going forward. It's much cheaper for them to do it that way than to buy the business outright and then figure it out. So it's effectively the try before you buy scenario. Now, the third one is that effectively you can become for them an experimental R&D lab. So if you think about the bigger companies, often they're sort of bogged down by compliance, by governance, etc. Whereas you as an innovative startup don't have the same sort of restrictions that they have. So the way they see it is you can be much more efficient than some of their own internal divisions, which is why you see so many investments being done by the likes of Google, Microsoft, Meta, etc. Because they know that once that's incorporated, effectively there's a whole bunch of governance that comes at play at that. But effectively they're getting access to your speed and agility and also your innovation pace that they can't do it at. So what that means for them is they've effectively got an R&D lab, which is solving their future problems that unlocks new layers of value for them, right? So they're the three ways to think about why sometimes they do a try before you buy or do an investment before they actually acquire. So it's strategic alignment for them, try before you buy, and then also you basically becoming their external R&D lab. So the strategic partnership, pathway, and this is the Quantium and Woolworths example, is that, and as I mentioned before, their first bet they took was actually $20 million. Now they took a 50% stake, which is unusual. Normally it's about sort of 20 to 30%. Now they wanted to understand what data they could get access to, how they could create value from that, etc. Now that was what they did in their first move, and that was in 2013, I believe. In 2021, they upped that stake with an additional $223 million to 25%. Right now, in that, they're obviously buying out the founders, as part of that, right? And the reason is because the partnership was validated. They would have had 8 years of data which they could show how much value was being created out of that relationship and out of the data they were receiving, out of the insights, out of the personalization, etc. They would have had access to all of that. Best of all, that data would have been improving because the business got bigger. I think they've now got over $300 million worth of revenue, right? But from an investment perspective, they were able to not only make their own business grow because of it, but they were also able to get a 20 times uplift in that 8-year period in their investment, right? So from a $20 million investment to a $223 million investment, right? They basically created a long-term pathway for themselves to basically having control of that business. And it's just a beautiful example of why these strategic deals happen. As I said, you'd think that this would be something like Google that would be doing that. But if you think about it, it makes sense given that there's two dominant, sort of grocery plays in Australia, being Coles and Woolworths. Well, they get to own probably the best data insights in the country, to be able to understand how to hyper personalize offers for their clients and also understand what's happening in the market's perspective. So as a summary, financial exits are driven by EBIT multiples, so earnings multiples, right? So someone's earning $1 million per year. Someone may be looking to buy it for 2 or 3 times. 2 times if it's normal, or if it's really performing, it could be 3 times, etc. But they're just buying a profit stream. But they're just buying a profit stream, right? And then of course, you as the founder, you as the owner, you're looking to grow your earnings so that you can achieve a higher valuation for your business, right? And then the only thing that differs is typically, what are the market conditions at that time? The strategic exits, as a recap, is driven by how they can leverage opportunities with their existing infrastructure, how the revenue opportunities they can create, the synergies they can create, the cost savings, etc. But their fundamental belief is that they have an ability to exploit your assets better than you, right? And they believe that because they can utilize the cash on their balance sheet, or it could be the share capital that they have access to, right? Networks, internal capabilities, distribution channels, knowledge, etc., to create a lot more value than what you are in your business today. That is why these deals are done. And if they're a listed company, often what they're trying to do is, in the listed company environment, you can achieve a better earnings multiple than what you can often as a private company, unless it's like an AI, hype crazy business. As a listed company, you can achieve a better earnings multiple, right? So what they're looking to do is, if, for example, if that company is trading at 10 times earnings, for example, or even 20 times earnings, let's say they've got 10 million of revenue. If they're trading at 10 times earnings, that means they're trading at $100 million market cap. Let's say they buy your business that's doing, $1 million earnings. I'll keep the numbers the same as I mentioned before, $1 million earnings. Let's say they can buy it for $3 million. What that means is, for effectively they can buy your business, they can take that earnings onto their balance sheet, that additional $1 million, and know that the market will revalue that at some stage, right? So effectively, that now they've got $11 million of earnings. At some stage, that's going to become $110 million. So effectively, what they bought for $3 million is going to add $11 million add $10 million to their market cap. Now, I'm giving that simple mathematics. There's a whole bunch of factors that play out sort of as part of that, but that's effectively what they're trying to do in layman's terms, right? Now, strategic exits, these are the most sectors which dominate most. You see it all the time, right? Life science, the entire sector is driven by this. This is what everyone's goal is, right? And there's a well-defined pathway for doing that. Software and technology. This is also the goal of what a lot of software and technology companies are looking to do, right? Then you got marketplaces also, right? You often see a lot of media companies looking to take strategic investments in marketplaces to help grow them, because they've got that belief that if they can advertise them through their media assets, they can help grow those marketplaces and then create. So Airtaxa, for example, had this with, I think it was News Corp and Seven, right? Well, I definitely do with Seven. I'm just trying to remember if it was News Corp was the other one. But effectively, those companies gave them a bit of cash and also a whole bunch of advertising to help grow the value of their ecosystem. Resources, this happens all the time. They build up an asset, or they get an asset to a certain stage where they can show they've got certain amount of resources, or they've got a JORC resource profile, and then someone will look to come and acquire it. And then it also happens in telco companies all the time as well, right? So the strategic buyers have a different internal scorecard, right? So they have to build their internal case by firstly answering the synergy question. How much value can be unlocked in the first 24 months? Now, this is a good metric for yourself, because if you're thinking about going down this process, these are one of the questions that they're going to be asking themselves, and that you also want to help lead them to on an answer front, right? What cost savings, what new revenue, etc. How would you operate your business differently, etc. They're also trying to understand the build versus buy question. So beautiful example was a company called Made Comfy, right? So Made Comfy dominated the Airbnb rental management space, right, in Australia. They did an incredible job. Oyo were looking to come into Australia. Now, Oyo, instead of actually sending it, going and hiring in Australia, throwing a ton of money at management, etc., building out a team here, then throwing, and basically just investing in all the infrastructure that's required for them to become the market lead in Australia, they just decided to buy Made Comfy, right? They bought it for $50 million, right? So they clearly decided that it was much easier for them to buy than to build it themselves, right? And it was less risky for them to do it that way. And then the integration question comes from their own scorecard. How easy will it be to integrate this company into our own existing business? And this is the question that everyone's trying to answer in AI. So basically, as the different models and the different companies start to win in their various areas in the AI space, basically all the power moves from the hyperscalers is going to be who can we acquire that either strengthens our long-term defensive moat or weakens our competitors. These are the moves so when Meta acquired Scale AI, because they've got effectively their sort of inbuilt AI tagging system, other hyperscalers were using that. Now, they knew that they were going to lose contracts as part of it, but they wanted to own that data, they wanted to own that information. Now, the narrative question is understanding that every person that's looking to buy you, they've got shareholders that they need to answer to as well. So they've got to help create a narrative as to why they've got to sell to their own shareholders, their own backers, why they're buying your business at a premium, right? That is part of their scorecard as to what they have to answer. And then the last one is the ability to create that EBIT multiple arbitrage, right? So they want to understand from their internal score, how possible is it for us to buy this business for X and add an additional value of Y? Now, the best example of this is CargoWise, right? And what they've been able to do with all their acquisitions, right? So as they've kept on acquiring more and more companies, they already had a very, very high earnings multiple, right? But as they've gone and acquired these companies, they've also basically they've continued to accelerate the growth of those businesses, right? But also been able to accelerate the growth of their own revenue with these acquisitions and continue with that high value. Even with all the scandals, they've been able to actually do that. So, very important to understand. All right, so then the next question becomes for them is, how do they actually structure these deals? And this is important because often, when a lot of people think about these opportunities, they often think about it as just being all cash. Now, of course, the great thing about all cash deals is you get the cash up front, right? Then often they do structure deals where there's part cash and part shares. Now, the reason why you do that as a founder is you think, well, I can take some money off the table, but hey, this business is also high growth, and I could get the potential increase in value in their shares of being a shareholder going forward. So if they're growing at 100% year on year, you may say to yourself, well, look, they've got good cash balance themselves. They're growing at 100% year on year. My shares also have the potential to grow at that value as well going forward, right? So you may think to yourself, well, yes, having part cash and part shares would actually be a great outcome. In the case of what a lot of Google, Meta, and Microsoft do, right, it's effectively they actually do a lot of deals in all shares. And the reason why founders do that is because they know they can actually trade their shares at any time, right? And actually, even some of the big unicorns do this as well, because there's a healthy secondary market for shareholders, or for secondary buyers for a lot of the unicorns. So they do that. In the case of Instagram, that was an all share deal. So those guys become super, super wealthy, not just from the purchasing of Instagram for $1 billion, but then from the uplift in value Meta. It was the exact same thing for the guys who sold YouTube to Google, right? They did that as $1.6 billion as an all shares deal. They knew they could basically get the cash at any time if they wanted to trade it in the public markets. But more importantly, they saw the value of what Google could potentially grow into. And if you think about it, that would have become a highly, highly valuable. If you think about what the value of Google was in 2006 compared to what it is now, right? So that's the different ways in which you structure. And often you can get a higher valuation the more shares that are actually involved. So some good examples of this, I won't go through them all, but one of my favorite ones was DataSite buying Ansarada for 236 million, right? The reason why that was so interesting was Ansarada was trading at a market cap of between 100 to 140 million, right? And yet they got acquired for 236 million in cash. Incredible outcome for them, because the company that bought them was well funded by a PE group. Now, interesting here is you notice I've put in how many acquisitions Google's done, how many acquisitions Facebook's done. WiseTech got so systemized at their acquisitions that what they would do is they had a template for the exact type of company that they wanted to buy. And they would run that template through they would have a corporate development team that would go out and source companies and run them through their acquisition program, right, to see if they met the metrics of what they were looking for in the various markets. So that's super interesting to know, because that's, when people get scaled at this is what they do. And then obviously Block, formerly known as Square, acquiring Afterpay for 39 billion at the absolute peak. Like, you couldn't think of a better timing for a deal of that kind to be actually done, right? I was actually at the peak of the market. I mentioned the AConnect example. That was just one of 148 of Oracle's acquisitions, right? And then I mentioned about the Oyo acquiring Made Comfy. All of these would have been various different reasons as to why they've done that growth. With WiseTech Global, a lot of it was around market entry. They wanted to find the companies that had the dominant position in the various areas that they were looking to go over. They wanted to take on their revenue, and then they wanted to sell their solutions to those customers in those actual markets, right? So really, really strong on that strategic long-term narrative and the consistent acquisition, and then using their share capital, using their listed company valuation to be able to achieve that, either with their ability to access cash from the public markets or use their shares to go and acquire, right? So that's that. Okay, so they're the two aspects that I really want to highlight, as far as what is the operational excellence they look for, and then also what is that strategic key narrative that they're looking to target. Now, for those of you that are interested, as I mentioned, we're going to be hosting the Business Exit Summit next week. So Tuesday next week in Sydney at the Ridges Hotel, we're going to be hosting this conference. And I said it's the only time we're going to do it. We're bringing together the people that you consider the architects of the ecosystem. So the people you read about in the AFR, they're the ones that we're going to be featuring. Sam is an example. No one has more data on what success looks like when it comes to M&A than him. His platform, Ansarada, oversaw 25,000 capital transactions, either M&A or capital raising. He was investing into AI going back to 2019 because he wanted to understand what success looks like in the lead up to a transaction, right? And then likewise, everyone else said can provide those insights. We've done our best to assemble effectively the founders that have done, 8 and 9 figure exits themselves, right? Both in Australia and also in the US, right? The advisors that actually help facilitate and, negotiate those transactions, and then the investors which fund the deals in the lead up to either an IPO or a strategic exit. All those 3 elements are required in the process. All those 3 elements are going to be at the summit next week. It's the first time I've ever seen those group of people all in the one room for basically providing this kind of value. So now as an attendee, you'll get access to both pathways, both the Fortress Builder and also the Key Forger, right? So being able to understand it from both lenses, because whether you're looking to do it now or whether you're looking to do it in the future, each of those aspects is important if you want to maximize the value, whether it be for a capital raising or for a strategic exit. So as I mentioned, Sam, no one's seen as much as him. He has deep insights on the data aspect, and effectively, as I said, he's probably the most known person in the M&A space in Australia because of what he did with Enserata. And more than that, he actually did his own exit for $236 million. More than that, what was even more interesting was they decided to carve out an asset in that business that he continues to run today. So not only did he sell his business, he also had another business to walk into the next day after he did, that he's now basically building and growing at the moment. Rajiv, mate, Raj is the best guy. I said he's been a bit of by the way, Sam's been a mentor to me. I cannot tell you how great Sam's been to me personally as a friend and as a mentor. Raj, likewise. There's I'm fortunate enough that I can catch up with these people, catch up with them, have lunch, etc. He's invested into 40 plus companies that have gone through an exit. He knows exactly what he's looking for, what are the metrics he understands, what's the people, what's the structure, etc. And he obviously manages a lot of money, right? So he's the leading VC or investor in Australia when it comes to investing into pre-IPO companies or companies thinking about an exit. Dr. Craig West, he's facilitated he's advised over 700 companies through their exits, right? He has got this down to a fine art in what they look for, how they help companies prepare, how they help them position, etc., right, to help companies prepare for their own business for that exit pathway. Pete Seligman said he's a renowned entrepreneur through acquisition leader. So ETA has become a high growth area. So ETA is basically what a lot of people are doing now, instead of starting their own business, what they're doing is they're actually basically raising capital or getting investment using their own capital and then buying businesses and then effectively going and running them. Well, he's the biggest in the country. He's built his own network of, basically people looking to do this, looking to buy businesses that they can then go on and run. He's built 5 search funds. He's completed 5 search fund acquisitions, and in that he's had 2 exits. And as I said, he's built the largest community of new investors seeking ETA opportunities. Then we've also got Lisa Merriweather. If you look at those brands, effectively, they're all some of the biggest, ASX 200 listed companies, the technology companies you've seen in the media, the family obviously. Well, she was the one working on those deals at Arnold Bloch Lever as an M&A legal specialist. So she not only understands the transactional side, she very much understands the personal side as well as you're going through these transactions. And I'll give you a personal insight. For me, I remember, in working with your lawyer, they get to see everything in the emotional journey you go through, because they have to give you effectively the fear of God scenario and then also the pragmatic, reality as well. And I remember me going through my transaction with Investec. I remember there was one stage where I was in Malaysia where I actually had a breakdown going through that process, right? So it's important to understand not just the mechanics of it, but also the personal side of it as well. Sean Bassett, mate, him and Chris Rolls are absolutely amazing. I was a small investor into their first fund, the PyLab Ventures Fund. It's done incredibly well. You can see some of the returns that they've been able to achieve with some of their investments. They've obviously returned far more than what I've invested into it. They've now set up what's called the Forever Acquisition Fund model with the PyLab Council Capital Fund. So all they are doing is just looking to buy businesses that they will hold forever. This model was done by a company called Constellation Software, which is now a $30 billion listed company in Canada. They're doing that in Australia, and all they are doing is looking at basically businesses they can acquire, for their funds. So he'll be going through what they look at, how they approach it, what types of companies they're looking for, etc. And effectively, as I said, there's never been a room put together of this kind based on this aspect of actually helping guide companies through their strategic capital and through their exits. Effectively, to have insights from over 27,000 transactions, to have experience with facilitating over 1,000 exits, right? To have investors that have backed 20 companies that have gone through an exit, whether it be an IPO or an M&A transaction, and also then get insights from founders that have actually built and scaled and gone through their own 8 and 9 figure exit. There's never been a room like it. And I said, those brands that you hear about or that you've seen in the media or the transaction you've done, I'm fortunate enough that they sit inside the Capital HQ data and their wholesale investor database, because effectively they're looking for either opportunities to invest or they're onto their next opportunity, and they're always looking across what's happening in the market. I'm fortunate enough to have this. We've got people that have listed, we've got, I think, two people that have been involved in, no, one person's been involved in listing on the NASDAQ, listing on the ASX. We've got someone coming to talk about even SPACs, right? As far as what investors are looking for when they're looking to fund, SPAC pipeline opportunities, right? So this is such a unique group of people to get together. And that's why I keep on saying, right, one conversation can make a difference in the trajectory of your business. One connection can make a difference, whether it's who they can introduce you to, right? Or one insight from one of the panelists could make a difference. This is not just about what you get from the day of the event and how you sort of turn that into instant cash. This is how you can start engineering the value of your business going forward. And that's why, to me, it's been a monumental effort sort of bringing the different people together. And effectively, across 2 days, we've got deep dive sessions. You get one-to-one access to the people. We've got plenty of breaks, plenty of networking opportunities. Obviously the case studies from the founders with their 8 and 9 figure exits themselves, like the real truth behind what it's like. Because like with Sam from Ansarada, his example sounds all glossy from the start if you just read the media headlines. When you understand what he really went through, it's a whole different story. But most importantly, we want you to take home your own exit blueprint, right? We want you to be mapping out your own process for whether it be 1 year, 2 years, 5 years, 10 years, right? At least you'll have that pathway going forward. All right, ladies and gentlemen, well, I'm just going to leave that up. But that is all for tonight's session. As I said, we're not going to be running this event again. It's a one-time only. We want to do it as part of our movement into the sort of business exit area. So please take advantage of it. I said, you can either spend 2 days in the office and normal days in the office answering emails and doing what you normally do, or you can actually spend 2 days understanding how you can engineer what you really want and the value you really want to extract for your business. So on that, thank you everyone for coming along.